Thinking about starting to invest in 2026? Then you need to hear this. The first thing to understand is that 2026 isn't going to be a boom year, and it's not a crash year either. It's a transition year. For the last few years, the markets have been running on hype, easy money, and a whole lot of emotional buying. Well, that party is winding down.
Ow.
In 2026, the fundamentals are back in charge. Interest rates still matter. Inflation might be lower than the crazy peaks we saw, but it's not gone. This new reality creates a clear divide. Companies with weak business models, the ones that only survived because money was cheap, they're going to struggle. But the strong companies, the ones with real profits and solid balance sheets, they're built to last through this transition. So, with this new landscape, how should you approach investing? Let's break it down by age, because your strategy should match your stage in life. If you're in your 20s, your greatest asset isn't money, it's time. You have decades ahead of you, which means you don't need to get every market prediction right. What you need is consistency. Forget trying to time the market or find the next 10-bagger overnight. Your focus should be on building a solid foundation. Think index funds that track the whole market, like the S&P 500. Think long-term ETFs in growing sectors. And think about high-quality growth stocks companies with a proven track record and a clear path for future expansion. For you, the power of compound interest is your superpower. Drip-feeding money into your portfolio month after month, even small amounts, will build incredible wealth over time. The goal isn't quick profits. It's about establishing a lifelong habit of disciplined investing. Now, let's say you're in your 30s or 40s. You've likely got more responsibilities, maybe a mortgage, a family, or bigger career goals. Your financial focus needs to shift from pure growth to a more balanced approach. You still want growth, of course, but you also need stability and a layer of protection. This is where you start blending different types of assets. You might keep a core of growth stocks, but add companies that pay reliable dividends. These dividend payments can provide a steady income stream and tend to be more stable during market downturns. You'll want some exposure to technology, but be selective. Instead of chasing every new, shiny object, focus on established tech giants that are profitable and innovating in key areas. And crucially, you should start incorporating safer assets into your portfolio. This doesn't mean hiding your money under a mattress, but rather allocating a portion to things that hold their value when stocks are volatile. It's about building a portfolio that can grow steadily while also weathering the occasional storm. If you're approaching your 50s or beyond, your investment philosophy should undergo another significant shift. At this stage, risk management becomes more important than maximizing returns. Your primary goal is no longer just about growing your nest egg, but about preserving the capital you've worked so hard to accumulate. Generating a steady, reliable income to support your lifestyle in the coming years is key. This means diversification is no longer just a good idea, it's absolutely essential. You'll want to be spread across different asset classes, industries, and even geographical regions to minimize risk. Chasing hot trends is a game you can no longer afford to play. Instead, your focus should be on quality, stability, and income. Think blue-chip dividend stocks, high-quality bonds, and other assets designed to provide predictable cash flow. Your portfolio should be a fortress, not a race car. So, what does the market forecast actually suggest for 2026? Which sectors are poised to do well? We're seeing a few key themes emerge. Areas linked to artificial intelligence, clean energy, modern healthcare, and infrastructure are expected to remain highly relevant. But here's the important distinction. They're not relevant just because they're trendy. They're relevant because governments and major corporations are pouring billions of dollars into them. This isn't speculative hype, it's long-term structural investment. At the same time, the purely speculative assets, the ones with no real earnings or utility, will likely face continued volatility. This is where most beginners lose their shirts, by jumping into higher-risk plays without understanding what they're getting into. The key lesson for every investor in 2026 is simple. Investing is no longer about being the fastest. It's about being the most disciplined. Smart investors don't panic over every news headline. They follow the data, they analyze company earnings, and they invest based on long-term demand. So, If you're planning to start your investment journey in 2026, my best advice is this. Do not wait for the perfect time to enter the market. It doesn't exist. The perfect time is a myth that keeps people on the sidelines while opportunities pass them by. Instead, start with knowledge. Read books, watch videos, understand the basics of what you're buying. Then, start with a plan that aligns with your age and your financial goals. Most importantly, once you start, stay invested. Don't let fear or greed push you into making emotional decisions. Real, lasting wealth isn't built in a day. It's built over years of consistent, disciplined action. Thanks for watching, and don't forget to subscribe for more insights to help you navigate your financial future.